Okay, so we are live. Plenty of people coming in already. So thank you to everybody that is joining us. Thank you, Julie and Carl, for joining. We were early. We've had a
Morning.
bit of a run through. We've practiced the screen share. So there's hopefully minimal technical issues on today's webinar. But as always, expect the unknown with us, right? Something's bound to happen. But hopefully things will all go accordingly. Morning, Amanda. A few people coming in now, so that's really good. So hoping you can all see my screen. The chat function is live, so we'll give it sort of 10-15 seconds and we'll get going today, because I can appreciate that time is of the essence today. I think Julie's got an 11 o'clock sharp meeting that you got to be in attendance to, so we'll try and do everything we can to get you there on time. All right.
Thank you.
No problem at all. So yeah, happy Friday to those that are joining us live. Thrilled to have you with us for another installment of our Friday webinars. We've got a fantastic topic today, with more lined up that will see us all the way up until Christmas, which is absolutely bonkers. Where has this year gone? It literally just goes in the blink of an eye. December next week. So as always, we have a few housekeeping notes before we get started. Session today, we expect it to run for the full 45-50 minutes. Feel free to use the chat function throughout to ask any questions to any of the speakers on any of their slides. As soon as they pop up, we'll do our best to get those answered for you all. We've also prepared a couple of interactive polls to give you a little bit more of an insight into our discussions today. So we'll also share those with you as we go along. So let's dive in, if I may. As always, we've got a good mix of club members and non-club members with us today. So for those of you who might not know or might not be familiar with us, I'm Lee, co-founder of the Financial Planning Club. The business is really split into two. So we've got the club and we've got the community. So if you're a business owner looking to take your business to the next level, the club offers a tailored membership designed just for you and your business. We provide everything from strategic planning to focused 90-day accountability sessions, helping you stay on track and work towards your personal and your business goals. And then for everyone, there's the community, which is completely free and hosted on WhatsApp. It's split into 5 specialized groups offering peer-to-peer technical support and a chance to upskill alongside like-minded professionals. So whether you're here as a member or just exploring, we're glad to have you with us. So thank you for joining. How did that get in there? Obviously, I put it in there. You've absolutely got to be proud of what you achieve. So we've been shortlisted for a Professional Advisor Award, Best Support Service for Advisors. It's huge recognition. You've got to be proud of what you achieve. Everything we do at the club is about enabling businesses to be the best they can be, giving them all of the tools, resources, and the community to do so. So it goes to show that if you are being laser-like focused on what matters the most to you and your business, then you will not go unrecognized. All right. So that's a huge moment for the club in a very short period to be, recognized. It's amazing. We're really proud of it. So we'll be attending those events, that's for sure. Touching on the club briefly, the club is a thriving community of business owners leading the way in financial planning. Everything we do centers around accountability. So if you're ready to implement fresh ideas, create clear business plans, or set ambitious goals, and surround yourself with a supportive network of like-minded business owners that are on a similar journey, then we'd love to connect with you. So grab some time with us and see how the club can help you elevate your business and achieve your long-term strategy goals. This is a really cool tool, so check out this amazing tool. So our scorecard is a fantastic resource that helps identify the areas of your business that might need a little bit more attention, and maybe you don't know it needs that little bit of extra attention. It is a valuable exercise, especially since we all spend so much of our time working in our businesses rather than on them. Sometimes taking a step back to assess and reflect is key to growth and improvement. So we'll email this out to everybody at the end of the session so you can dive in and see how it can make a difference to you and your business. If we look at the community real quick, this is where it sort of all began for the club. So for the past 2 years, we've hosted thriving communities on WhatsApp. It's split into specialized groups to keep the conversations relevant and focused. People love being a part of something bigger, sharing ideas, tackling challenges, and connecting with others who truly understand their roles. The best part about it is, I suppose, without a doubt, someone in the group has been there, done it, bought the t-shirt. They've navigated similar challenges, and they're more than happy to share their experiences with you all. So it's all about just helping each other succeed, and that's so important to every one of us at the club. So if you're not involved yet, you can join under our website under community. Collaborators, we couldn't do what we do without the amazing support of our collaborators. 2 of those are with us today. We have Octopus Money and Open Door Policy. Both Julie and Karl join us today. So from platforms to compliance, recruitment, training, websites, marketing, mystery shoppers, and everything in between, each of our collaborators play a key role in the success of our club members. They share our commitment to driving the industry forward. Their expertise, their passion and innovation help make a real difference. So feel free to check out any of these collaborators, and I'm sure they'll be more than willing to help. So big thank you again to every one of our collaborators. What's coming up next? The guys from Way Trustees next week are talking all things inheritance tax planning in a post-budget landscape. We've had huge sign up for this, so we expect it to be really engaging, lots of questions along the way. And also, back by popular demand, we are rerunning the webinar with Aspen for the ultimate guide to building a CIP. Again, we ran this a few weeks ago. It was a good hit. There was plenty of questions and answers thrown around. We do record all of our webinars. We had a little technical glitch, which is one of the reasons why we're going to rerun that webinar and invite those who wasn't able to attend on the day. Or in fact, if you want to come back again and you've got more questions, you are more than welcome to do so. As always, register on the website. I believe there will be a link on the chat function soon for you to register to any one of our webinars. So moving on, that's enough of me. Moving on to today's hosts. So today we are joined by Julie, who is the head of advisor distribution at Octopus Money, a brand dedicated to making financial advice accessible to everyone. Julie works closely with financial advisors, helping them discover the best way to support smaller clients and bridge the advice gap effectively. Outside of work, which is interesting to know, Julie is saving for a farm big enough to never say no to any dog that needs a forever home. You have 4 already. My one drives me bonkers. How you manage 4 is unbelievable. So hats off to you on that. We're also joined by the amazing Karl. So Karl is the former head of Business Consultancy at Simply Biz, brings over a decade of experience supporting advisor firms. So after 10 successful years, he founded Open Door Policy, a consultancy dedicated to helping practices answer those important why and how questions on critical subjects such as charging structures, price and value statements, and building robust centralized investment and retirement propositions. That is an absolute mouthful, Karl. Thanks for that one. Karl has 13 guitars, and as you can see, he's also a keen drummer and a musician. And Karl is kicking the webinar off today. So Karl, over to you. Feel free to share your screen. I'll stop mine, you start yours, and then we'll kick things off.
Thank you very much, Lee. Hello, everyone out there on this wonderful Friday morning as we're all barreling towards a great Christmas. So I'm sure we'll all enjoy ourselves on that. I've got 3 screens, so I'm just going to move you guys over here onto my screen over there. That's why I'm looking there. So I can start my presentation in the middle and then look at you guys. So I'm just about to share my screen now. This did work in practice, so it should work now as we're live. So
we are live. Confirmation.
Awesome stuff.
We've got the right screen. Not your
Brilliant.
Black Friday deals.
Excellent. We've got everything going. As you can see, I am the owner of Open Door Policy, and I build propositions. So I work with firms to make sure that the charges or clear, fair, not misleading, and they're also documented. So if you get that knock on the door from the regulator inviting themselves in for a cup of tea, then you've got all the answers written down. I also designed centralized investment and retirement propositions, CIRPs, as well as consumer duty stuff. And then I wrap all that up with an annual review process to make sure that firms are fully up to speed consistently with these three major propositions. What we're talking about today, as you can see there, is mind the charges gap in brackets. Now, the reason why I put the brackets in there is there is different definitions of what a gap can be, whether it's the advice gap, the charges gap, call it what you will. So at the beginning of the presentation here, I'm just going to give a quick definition of one of the gaps that we're going to be looking at today. We're going to look at what it is, but more importantly, what can we do about it, both individually as firms, but collectively as a profession as well. So let's move forward here. Looking at the charges gap, as I said, there is different definitions when you look at various publications from various people out there. And one of the definitions here is the amount of investable assets below the capital threshold required to support a firm's minimum ongoing charge. What the hell does that mean? Well, what that actually means is your client needs to bring a certain amount of money to your business to meet your minimums, to meet the amount that it takes you to bring your service to the marketplace. It's literally as simple as that. If we look at an example, first of all, define your cost of manufacture. Now, that was in the Consumer Duty FG 22.5, section 710, which basically says that firms, when they are manufacturing a service, which is obviously advice firms like yourselves and everyone else out there as well, needs to assess the cost of manufacture, or how much it costs to bring their service to the marketplace. In other words, what your minimum charge should be. Now, to do that, you need to identify what your minimum investments would be to actually do that. And the simplest way to do it will be to look at an example here. Let's say, for instance, that your minimum charge is 1,100 with an ongoing service charge of 0.75, a very typical scenario. I've worked with literally hundreds of firms in designing charging structures and doing a virtual time and motion exercise. And it's very, very common for firms to, first of all, be surprised at how much their cost of manufacture is. And a lot of firms are actually have a lower minimum than they really should have or what they expect. But secondly, how much it is as well, and how much it should be. So if we then move that on into how much money you would need to meet your minimum fees of 1,100, it comes to 146,500 give or take. And that's your cost of manufacture. That's also your personal advice gap there as well. So this is the amount that is pertinent to your business. So this is one definition of the advice gap, obviously. Now that is unique to you at a firm, but it doesn't mean that you've just got one gap, because you may have several situations with different charging structures, maybe it's different ongoing service levels, or maybe it's even you split it between accumulation and decumulation. Now that's really important, because that's definitely one of the directions of travel from the regulator, is basically saying, hang on a minute, what do you guys do, IFAs, for clients who are in decumulation? Given in mind, you probably need to do a completely different advice process for that, bring in such things as sustainable withdrawal limits, looking at cash flow modeling, and absolutely certainly on an annual basis. So don't think you've just got one gap. You will have different gaps depending on the sort of clients you have, your segments of clients, and who you actually deal with. So then, there is obviously, that's only one charge, and it's the only charge we can really look at in detail, because it's the only one where you can identify the cost of manufacture. The cost of manufacture for other charges is up to other manufacturers to do. For instance, there's going to be a cost for your product or your platform, usually coming in at 0.3, sometimes maybe it's a little bit more expensive than that, depending on your client and how you actually manage their particular circumstances. There's a cost to provide the investment solution that can range that can vary quite a lot, as you would imagine. For something as low as 0.2, I've even seen some firms coming in with 0.15, up to around about 1, and even above that. So let's take sort of a middle ground on this, which is 0.6. Then you've got the cost to provide the advice, and again, that's slap bang in the middle. The range of ongoing advice fees is between 0.5% and 1%, and this is taken from data bulletin number 7, directly from the regulator, so it's their figures, not ours. And then that comes into a total of around about 1.65%. Okay, so let's look at this one here, which is the 0.75 and the minimum fees here. We've got a minimum fee of 1,100 with a capital threshold of 146,666. And let's just throw it over there. Now, the reason why I'm doing that is there is various different things we need to consider to actually reduce that advice gap, reduce that capital threshold amount, because in theory, if a client came to you with, say, 75,000 or 50,000 or something in that nature, if you were to impose your minimum, then obviously the effective charge wouldn't be 0.75. It will be greater than that. And you may be getting into the territory which is under the price and value option within the consumer duty, where the regulator wants to ensure that charges are not demonstrably higher or lower than the rest of the marketplace. So you don't want to be getting in a situation where the effective charge for a particular client, if you impose a minimum, is over 1%, for instance, 1.2, 1.3, or even higher. That's a sort of area which may cause concern. So we need to be able to sort of have mechanics in order to deal with that. So if we got a minimum fee of 1,100 here, let's see certain aspects, certain things we can do to actually reduce that. This is the what are we going to do about it section. First of all, you could have a reduced service. Now, maybe that reduced service means that you don't see the client face to face, you do it remotely like we're doing now. Maybe it involves remote email stuff, the greater use of technology. And that reduced service might mean that your minimum fee is 1,000, therefore bringing the capital value or the capital threshold down to 133,000. You may want to consider better and more use of tech to build efficiencies into your business. I know from speaking to, again, hundreds of firms, it's quite common for firms to say, yes, we've got XYZ, we really like the software, we know we're not getting the best use out of it, maybe so we need to spend some time in actually doing that. And there's some great companies out there, and great companies which are part of the FP club, which can actually help you with that, to say, let's have a look at the tech stack, let's make it better, or why not look at alternatives as well. So it's certainly a way forward in reducing your cost of manufacture. Then you may want to look at outsourcing, a great way of ensuring that work is absolutely nailed on and is going to be done, and B, releases you from having to do certain things within the ongoing review. Now that has a double whammy effect. Sometimes you may find that it's actually more cost effective to do that with regards to pounds and pence, but secondly, think of the time savings as well. Think of the return on investment that you're going to have within your business, whether or not you're a sole trader, or even when you've got administration and paraplanners working with you as well. I find that this works particularly good with sole traders who never have enough hours in the day, from the conversations I've had with them. And then we could look at a whole new RFI, which may bring down your fees even more. So you're lowering that advice gap. But what's all that about? What the hell is an RFI, and what is that particular direction of travel we can look at? Well, basically, this is where we're looking at the connectedness between charging structures and centralized investments propositions and CRPs. What we're finding is one affects the other and vice versa. And indeed, the regulator picked up on that in their latest price and value guidance, where they says you need to look at all this holistically, because one of the outcomes is going to affect the other, which is going to affect the other. And this is where this actually works in practice. Product governance is a great piece of kit in order to run a CIP and a CRP, or a combined CIRP if you're putting them both together. And it's really simple, really. First of all, you need to look at segmenting your clients. Obviously, you would segment your clients via the handbook way, which is looking at retail clients, professional clients, etc., etc. But let's go one step further into that to make it more granular. Here we're looking at segmenting your clients based on particular client circumstances, not assets under management, not on your service levels, but based on there's a bunch of clients here who are all in a very similar sort of situation, and then there's another bunch here. Maybe we've got two segments, or we got three, or we got four, depending on your business model. What normally happens when I work with firms on this basis is we'll find that you would split down into accumulation and decumulation clients. Pre-retirement, post-retirement, and that is very popular way to actually do that. And it meets the regulators' sort of direction of travel as well, because they're looking at income in retirement and what you guys do for clients in the decumulation phase. So it dovetails very nicely with the way that the regulator's going as well. So once you've segmented your clients, here we've got three segments there, then we need to look at this thing called RFIs. Now, the RFIs is just relevant financial instruments. Now, this is all the stuff that you can use, that you have at your disposal to provide a solution for your clients or your segment of clients. And these range from simple things such as depositing cash accounts up to risk-rated multi-asset funds, actives, passives, all the different sorts of bonds, MPS solutions, DFM solutions, up to and including products and platforms as well. Although strictly not a relevant financial instrument, it works well within this model. So you're making sense of everything you've got out there in the marketplace. Some relevant financial instruments you will want inside your CIP or CRP, and some you will not want in there. A really good example of that is peer-to-peer lending, for instance, or even something as simple as MPS solutions. Some firms don't agree with MPS. Some firms do. So some firms will have them in and some firms will have them out of the CIRPs. And you know what? It doesn't really matter. There is no right or wrong answer to building this. There is just justification on why you do what you do. So it's perfectly acceptable to have a firm which would go down the MPS route, and it's also equally as acceptable for firms not to do that and have preference to multi-asset funds, for instance. The choice is always you guys, as long as you have it documented. So once you've sorted that out, you've done your segmentation and you've done your relevant financial instruments, it becomes very easy to say, oh, segment one actually fits in with all these relevant financial instruments. Segment two also fits in with all these relevant financial instruments. And that may be something as simple as pre-retirement and post-retirement. Segment three in this particular area actually doesn't go down to any of them relevant financial instruments, but goes to a whole new subset of relevant financial instruments. What we mean by that is there is now products out there and solutions out there which are being specifically designed for the lower end of the market. So the idea here is you would segment clients on that basis and then use this whole new subset of relevant financial instruments which are starting to emerge and starting to come out to specifically address the advice gap. So the clients would be actually better served outside of your business. So why is this gap important, and why are we talking about it today, and why are you guys sitting there with cups of coffee listening to me talk on a Friday morning? Well, it's important because if we look at price and value, you're obliged to construct your price and value statement, which will identify your gaps. This is something that you're going to be doing on an annual basis through your price and value statement within the consumer duty. It's also about delivering an ongoing service and looking at the regulatory direction of travel. So making sure you explore what's happening in the marketplace and making sure that your service delivers what is expected. It also means delivering a range of ongoing service, which is again linked to price and value, to ensure that your clients or the segments gain the benefits for the service that they bought. Because obviously, when we're talking about price, that's the cost you pay, but that needs to be set against the benefits that the client is getting from that service, which therefore equals the value equation. And then lastly, decumulation clients. This is an interesting one. What happens when your client starts taking income from their capital and it hits the point where their capital value can't meet your minimums any longer? What do you do in that situation? And here we're butting up pure logic against empathy as well. You guys have got clients out there you've probably known for years and years and years, and you might be writing your 25th Christmas card to them as we speak. You know, it's not all about spreadsheets. It is not all about, what is your cost of manufacture. It has to be tempered with actually dealing with real live clients and what is the best route for them. So again, this is something that will be developing within further webinars, further discussions, and thought leadership pieces here. But there is absolutely, certainly a lot of ways that you can help clients at the lower level. And the one we're going to explore in more detail is these newfangled RFIs, or relevant financial instruments. Hence the reason why Octopus is also on this particular webinar. So that's me done for the moment. Hopefully that gives you a good introduction into what we're actually talking about with this particular advice gap and the sort of challenges that you guys have, and giving you an idea of some of the options available to you, but absolutely looking at particular solutions from particular manufacturers. So over to you guys. If you've got any questions, I really want to see those fingers on the keyboards. Let me know and we can answer them.
Also got a little poll here that I want to run as well. So for the people that are in attendance, if you wouldn't mind just casting your vote, because Karl might be able to shed some light on what he sees in the industry as well. And it's just about how easy would it be for you to explain how you've arrived at your charging structure. I know that's quite important, your minimums, your maximums, and threshold values, etc. Do you find, Karl, that not everybody knows the answer to this question?
It's very common, a very common answer to the question about how have you arrived at your charges is we've always done it this way, or we've seen what other people do in the marketplace, especially when it comes to setting minimums. This is the reason why 95% of the clients I work with are quite surprised when they actually see, doing the virtual time and motion exercise, how much their minimums actually should be, and therefore makes it even more important to look at ways of bringing that down using tech, using outside outsourcing, different RFIs, as we're going to go on to.
Yeah, makes sense. Yeah, it makes sense. We've had quite a few people vote on it already. So anyone else want to cast their last vote? There's a couple of people sitting there not voting. Not going to call you out, don't worry. But if you can get a vote in, that'll be amazing. We'll share that back. Actually, it's quite surprisingly, actually, 55% of people. 50%. That's just dropped. Someone casted a vote, but it's quite easy. We did some work on it. It's dropped again. A few people are throwing in stuff. I feel like I'm at the races. It's a moving number, this one. What I'll do, still moving. People are thinking about it. Do I know how I got to where we are today? We're all but there, so I'll end the poll, share the results for you all. So yeah, just under. I mean, it was at 55, so a couple of people threw in a few votes, but 43%, which is leading the way, say it's quite easy. They've done some work on this, which is good to hear, right? Nice to hear. Yeah. And there's a few that sit down on the other end of the spectrum, as in it's difficult, it hasn't been documented to any great length. Maybe definitely something to look at in the near future, maybe. But now we hand over to Julie, who's going to be talking about a bit of a solution for that category of clients that don't quite meet the thresholds that Karl was talking about. So, Julie, over to you.
Yeah, good morning. So as Lee said, I'm Julie Greenwood. I'm the Head of Advisor Distribution at Octopus Money. Oh, I've done another little pop-up on my screen. So and I'm
that off your screen? I think I stopped
Yes,
sharing.
it's gone.
Oh,
It's
brilliant.
gone.
Good,
It's
good.
gone. So super happy to be here today. It's a great way to spend a Friday morning. So what I thought I'd do is share some of the insight that we've had from the meetings we've had with advisor firms over the last few months, and also some of the recent research we've done, and see whether it resonates with the answers to some of the poll questions, or whether that throws up some food for thought. So today we're going to be talking about the commercial gap. So it is, as Karl said, there's lots of different types of gaps, but we'll have a go at this one. So Consumer Duty, it gave us a real opportunity to reflect on that target market. So who is it we're here to serve, and actually do the mapping of the delivery cost. And we did a piece of research on the anniversary of Consumer Duty. And what it showed us was that the cost of delivering a single advice case has more than doubled. So that was pretty eye-opening. And actually, on average, a new client needs to have 214,000 to be onboarded by a financial advisor. So again, that cost has gone up since the last time we ran the poll. So what that basically means is that advisors are making really conscious decisions about focusing their time and talents on people with larger asset levels and more complex needs in order to make sure that that advice is profitable. But of course, the difficulty is that we've only got 8% of adults accessing financial advice in 2023. So you've got a demand issue, you've got a supply issue, and there's a bit of a gap in the middle. So when we were looking at our research, 75% of financial advisors say that serving smaller clients, and it's a really difficult term, but clients with lower levels of assets, modest value clients, however, whatever the best way of describing them is, but 75% of you said that it was becoming a significant challenge. You were focusing, 45% of you were focusing on doing a shift towards acquiring higher value clients, and a third of you have increased your level of fees. And basically, when we're sort of chatting with advice firms, we're having a conversation about, what is your cost to serve? Are you really clear on it? And actually, the answer to that varied enormously. So I know, as I say, Lee ran a poll in advance of the webinar today in terms of what is your cost to serve. And some of the challenges, I mean, some people were thinking about revenue, some people were thinking about profit, and actually that in itself gives you, again, a different dynamic. And I heard everything from £300 in my conversations all the way up to £3,000. I had one firm telling me it was exactly £637 to deliver an annual review. But then he said, but then when it came to the budget, and then of course clients were phoning in, sort of needing comfort, needing support, actually all of that was pro bono work. So they costed out delivering one element of a relationship, but not the whole admin, comfort, answering questions around volatility during the year. And it also varies enormously geographically. So we had some firms say 150,000 in terms of minimum levels of assets, some say 250,000. And then I had a call with an advisor in Paisley, which is just outside Glasgow. And the guy said, oh, 80 grand, I'd snap your hand off. So it literally varies, so hugely, but definitely something to bear in mind.
And I suppose this leads on to a poll that I'm going to run in the back of this as well, Julie. So this is about, how the advisors are incentivized within your business, right? And it's a very interesting question, and I'll be keen to hear the responses from people in the webinar. How are the advisors incentivized within your businesses? Are they incentivized to deliver profitable advice and profitable services? Is it purely just to generate revenue? Because then they're biting off your hand for the £80,000 client or whatever else, or is it just to retain? So this would be an interesting one.
I'm really looking forward to seeing the answers to this, because I've heard everything, and there's been a bit of a dynamic between business owners who are thinking about profitability and their EBITDA, and then advisors saying, well, actually, no, it's in my interest to look after Mrs. Miggins and her 50 grand, because that counts towards my asset target, it counts towards my revenue target. But even though it's unprofitable, the advisor, with the disconnect between what drives the business value and what drives advisor value. So a really interesting result there in terms of it's great that 50% of people have their advisors incentivized linked to profit.
Yep.
That is much higher than I've seen in my conversations. So that means obviously the quality of the financial planning club members is much superior to most. So thank you so much for sharing.
We've still got a few people to vote yet, because last time I gave a 50% comment out, it was moving up and down, up and down. So let's see how we go. But I suppose that's also important for the owner of the business and the advisors within the business to have their goals aligned and to have that strategy aligned, that 12-month mapped out. What's everybody doing? This is what we're working towards as an organization, as a business, and this is what you should be working towards as an advisor as well, right? So, but it's having those conversations. It's people that are building, people that are retaining. It's just, it's not one shoe fits all in some cases, is it?
No, but I think, as I say, that alignment is important, because otherwise you've got people working against each other. And I've had advisors saying, well, I'm not going to give up the clients because it helps me hit my target. And business owners are saying, well, it's loss making for me to deliver. So you can continue to look after the client, but we're going to turn your fee off. Or it's not going to count towards your target. And then the advisor saying, well, the fact that it's loss making, that's not my problem, Mr. Business Owner, that's yours. So yeah, super interesting.
Yeah, absolutely. So there's the results. The results are in. It's quite 50-50 between delivering advice and retaining assets. So it's quite 50-50.
Good for thought, though.
Yeah, absolutely, Gareth. Absolutely, we're gonna come on to that literally within the next couple of minutes, because I know Julie's got to shoot off. So we're gonna talk about the solution in literally a matter of moments. Julie, over to you.
Yeah, so one of the biggest statements that I've heard when I'm speaking to firms is that growth is constrained by advisor capacity. So actually the advisor gap it's only reduced very slowly in terms of the number of advice firms, but 90% of firms have under 5 advisors. So that oops.
That's me, don't worry, I'm just running the poll in the background.
Okay, no worries. But we have seen the number of advisor staff rising slightly between 2016 and 2022. We've seen a real shift in the shape of revenue. The ongoing advice fees account now for 78% of revenue, which is an interesting dynamic in terms of it is now focusing on retention rather than hunting for new business. Restricted advice firms, interestingly, make up 10% of the market, but 32% of the revenue, which again, I thought that was quite a interesting shift. And we definitely hear lots of noise in the market about the shift towards restricted advice. And PI premiums, you'll probably know this far better than I did, but this surprised me, have doubled between 2017 and 2022. So that's all about how can you, I guess, prove to the PI insurer that you're mitigating your risk as best you possibly can.
Yeah, absolutely.
So there was some real interesting stats there, but of course the need is growing. So the UK population is forecast to grow by 6.6 million. That's 9.9%, almost 10% between 2021 and 2036. So again, you've got an increased need. And according to Financial Lives, a third of the UK population have got numeracy levels so low they weren't able to demonstrate concepts like interest, compounding interest, inflation. So again, what that really tells us is there is a gap between supply and demand, and the need is growing and growing, and people need more help than ever. And that's why people, I guess, are looking at different solutions.
Absolutely.
So lots of thoughts there. Some of the other things that we're sort of hearing is, again, part of the driver of firms that are now, when you saw Karl's slide earlier on about what are the options and are people disengaging clients. Part of the driver of that is that need to evidence the delivery of the ongoing advice that's being charged for, including suitability reviews. Many of the advisors, of course, have more clients than they can serve. So they're thinking, well, actually, do I sort of start to turn off the advice fees and disengage lower asset clients? Some of the firms I've been speaking to are saying, well, actually, we'll offer transactional advice. We'll turn it off and say, I'm here if you need me. But then I'm hearing that what they're telling is actually the re-onboarding and the re-fact finding means that it's actually now loss making to do that as well. And even those that had a minimum fee were saying actually the dynamic is that minimum fee doesn't then pass the fair value test. So when you think about somebody that's got 30, 40 grand, if you're sort of taking 2,500, you know, that can be a really tricky one. But I wanted to bring it to life rather than me sort of giving you some research, give you an actual business. And this is an anonymised set of data that we've been doing some work with Catalyst Partners, who are an M&A expert in the financial services area. And this is a firm that they are selling. And hopefully you can see there's a bit of an issue with the story that we've got here. So the numbers tells us a bit of a story, and there's two parts to that. So the first is that half of those clients, so those that have got assets up to 100,000, only account for 14% of the advice fees. So 50% accounts for 14% mismatch. And then the same cohort accounts for just 9% of assets. Or if you looked at it the other way around, just under 25% of the client's assets represent 25% of the client's firm's clients represent over 70% of the assets and 60% of the ongoing advice fees. So again, you've got a disconnect here when you're looking at the value of your business. And actually, when firms are coming to sell and they're doing this level of data, it does, I guess, have some really interesting points to it. So it matters not just to the valuation of the firm and the firms that are thinking about selling, but it also represents a significant opportunity cost. So if you were able to unlock the time and resource that you're spending on those lower asset clients and direct it to people that have higher assets and more complex needs, then you can really use your scarce resources to where you can deliver the most value.
Yeah.
And it also means there's an issue for potential buyers. So potential buyers are saying, hang on a minute, we've got a whole tail of assets here. These are not profitable. I don't know what I'm going to do with it. Therefore, this business is less attractive. And there's also a hidden cost for clients because they're saying, well, you know, these clients are potentially either going to be paying a higher cost than they need to or be disengaged. So there's a real issue here. So we would really encourage firms to kind of, I guess, get to grips with your numbers. So in terms of things to think about, so in terms of action points, really do have a think of what do the numbers look like in your firm. So start mapping out the proportions of your firm's revenue and where that comes from in terms of those different cohorts of clients. And there's loads of firms. So obviously, Karl is happy to help. There's lots of other members of the Financial Planning Club, collaborators that would be more than happy to help you do this piece of work. And then understanding that cost to serve. So how much does it really cost to deliver that on initial and ongoing charge? And where you've got a problem, what can you do about it? So it could be that you're actually using tech to make the advice process more efficient. You're segmenting your clients and offering those different propositions. Some firms are bringing in junior staff and giving them the chance to, I don't like the expression, but cut your teeth on clients that have simpler needs. You can offer simpler solutions, you can offer self-serve, but essentially, if you can think about finding a different solution for those smaller clients, not only will you increase your average size from, say, your average AUM from, say, 210 to maybe 410, if you then come to sell your business, you will attract a higher multiple on that higher average value. So it's well worth thinking about making these decisions now because it literally can unlock millions of pounds when it comes to the value of your business. And of course, the alternative really is a lose-lose situation where your advisors are spending time and resources on people that have simple needs and clients are ending up, you know, with a model that doesn't really work and isn't really cost appropriate for them. So do have a think about, you know, what you do with your data. Have a think about, as you say, making time to look at your business and think about some of the options that are available.
Well, this is it, Julian. It just relates back down to the poll that we've just run and people saying that, you know, that 80% of people said that they're confident that they could attract and retain more of our ideal clients. And then you show results saying that one business, 40% of the clientele is under £100,000. It's not producing enough revenue. And it's just about, there's more time. We can have more time because these clients are taking up just as much time as everybody else. But there's solutions.
Exactly that. Yeah, exactly that. And I think that opportunity cost, you've got 80% of the poll respondents saying that they're confident they could attract and retain more of your target clients. So thinking back to consumer duty. And that is hugely positive, because what you're saying is if you can release that capacity, you can then hunt for the types of clients that will not only make your business more valuable, but where you can add the most value. Because some of the simple solutions that we have within Octopus Money, they are not appropriate for people with complex needs. You know, we need the chartered financial planners, the complex solutions to deal with people with complex problems. So it's just a case about, I guess, maximizing your super valuable resources, really.
So let's
This
talk
is
about.
where this is where product governance comes into it, to get back to something as stuffy as prod. But when you apply it to the real world, it's all about segmentation of clients, with particular solutions for that. So there's no reason in the world why you wouldn't segment these sort of clients and then do something positive to make sure that they are still served.
Yeah.
Yeah, absolutely. I was just literally going to finish off by saying, the call to action here is really develop that strategy for clients that are outside of your target market. So, think about the implications of not taking action are really quite severe for the value of your business and also for your clients. We know the temptation and that desire to help, that's just baked into every advisor I've ever met, but there are probably ways to achieve that better outcome. And obviously at Octopus Money, one of the things that we do is we acquire client banks. So those lower asset value clients, we're happy to buy, and we also pay for referrals. If people come to your firm who are looking for advice and they're outside of your target market, we will pay for those referrals. So as I say, help is out there in a whole different range of ways, and it's just finding out what works best for your business, really.
So the offering from Octopus Money, there's two offerings. So you'll pay for the referral side. So if a client comes to any one of these advisors' businesses that doesn't quite meet their criteria, you'll pay for those referrals.
Yep, exactly that.
If they're doing a review of their business and they're finding themselves in a similar situation to the slide that you shared with us, then Octopus will also purchase those lower value clients off of someone, which is interesting. So I had a question here that said, how do Octopus usually buy smaller client banks? Is it upfront? Is it staged? Do you accept future liability on those clients? What service proposition do you offer clients? And all importantly, are your advisors level 4?
All right. Wow, that's a load of questions. I'll break that down. So the way that we do it is it's super simple. So we have a template that we send out, but essentially we base the valuation based on the age of the client, the level of their assets, where their assets are held, and the ongoing advice fee that you charge. And we aim to pay between 2 and 4 times the ongoing advice fee. So in the last 9 books that have priced up that I was looking at this morning, it came out at 3.1 something. And then in terms of the process, what we do is we write out, so we do the process, we work with the advice firm in terms of there's different onboarding models. Sometimes the existing advisor likes to be on a joint call with Octopus Money and the client, where we introduce the service. And then the way that we look after clients is we've actually sort of reimagined the advice model. So what we do is we use our accredited financial coach. And the accredited financial coach uses our very simple cash flow model. Every client gets a cash flow model created. That creates then a financial plan, which is holistic. So some of the actions could be do your will, do your power of attorney, top up your investments, consolidate your pensions, anything like that. And then where there is an advice action like investing or pensions, then we use a regulated advice model. So that is essentially the best of humanity, which are accredited coaches, and the best of technology, which is the bit that gives the regulated advice. When we're doing transfer advice, we obviously use a human advisor who are between level 4 and level 6 qualified. So we do have a chartered financial planner. And essentially when we're buying those books, we pay 50% upfront. So when the clients sign up, and then 25% at the beginning of year 2, 25% at the beginning of year 3. So we're paying enough to offset, I guess, the loss of revenue, thinking about the revenue capital payment sort of profitability dilemma. So we pay 50% upfront because we recognise that revenue is lost when they turn off those advice fees, and then that we've got enough skin in the game then to say, look, we've paid for these clients. Our job is to deliver that Disney dust to make sure that they are super happy when they stay with Octopus Money.
Yeah,
Did I cover all of the bits there? So level 4,
it.
yes, we do.
You absolutely nailed it. In terms of timescales from first conversation, I obviously appreciate it can vary from business to business, but typically I reach out to you today. How far down the line, how long does it take for Octopus and said firm to come to an agreement?
Yeah, so we price up usually within 2 working days because we've got a model that's all ready to go. So typically we'll have a conversation. Then will go back and talk to their board directors. We'll do a demo so people can see the tool. Then they send over the template. Which usually the bit that takes the longest is them sending the information on the template. We price that up within a couple of days, and then usually they'll go back and get board approval. We share our due diligence pack and everything else. And then we put together a project plan, which is, let's talk about the communication, the onboarding process to make sure that we're going to deliver some amazing customer outcomes. And then we start that process. We've done the whole thing end to end in 4 weeks. And then, of course, it's just getting into the client's diaries, making sure they're comfortable, getting them signed up. And the conversion rate has been anywhere between 60%, where we had one firm that essentially wrote out and said to all of your clients, I'm sorry, you're too poor, but if you want help, go talk to this money, which was pretty appalling.
Yeah.
And then we had a brilliant experience where an advisor wanted to do some warm handover calls with us, the client and them, and we got 97% conversion rate. So it really depends on how much work the existing advice firm wants to put in. But I think the trick is communication. So it's making sure that when you're writing out to clients, it's not a case of, I'm sorry, you're too poor. It's a case of saying, actually, under consumer duty, we have an obligation to make sure we're delivering the most appropriate service for you. And actually, in our duty of care, when we've reviewed our costs, because the cost of delivering regulated advice has gone up, we've done research in the market, and actually we're partnering with Octopus Money, who we believe will deliver something that's really appropriate for your needs at a cost that's much more appropriate. So our charge all in, so for the coaching, regulated advice, the platform, the funds, the DFN, the client portal, that is 1.15, and there's no upfront charge.
There you go. So the moral of the story is we all need more time. We all said we want a little bit more time so we can focus on the clients and retain the assets. There are solutions out there. Octopus Money offer an incredible solution, end-to-end support for your clients that might be impacting your bottom line. So it's definitely something that you've got to consider at some point in your business, right? Because the lower value clients take up just as much time in some cases as the clients that are sitting on the upper end of the scale. And we all need more time because the polls suggest exactly that. So Julie, Karl, that's a wrap. We've done it in 52 minutes. So thank you again to everybody that joined us. There is a bit of a survey once you leave. I'd love to hear what you thought of the webinar. And again, please join our future webinars. Julie, Karl, thank you so much. It was a pleasure.
Thank you very much.
Cheers, guys.
Bye.